Hey guys, Akil Stokes here. Welcome back to the Trading Coach Podcast. We got another video episode in store for you today. So if you want to follow along visually, make sure you tune into Spotify or head over to YouTube. Now, speaking of YouTube, in this weekend's Trading Edge video, we kicked things off before hopping into the charts, of course, with a little bit of a news recap about what had happened in the market, why the market did what it did, and what to expect in the near future. And one of the big topics that we covered was the US Supreme Court ruling on the Trump tariffs, or more accurately, the ruling that we thought would happen that actually didn't happen yet. And interestingly enough, how that lack of a news event was probably the biggest news event of the week. After seeing that video, a handful of you guys reached out with questions about what was going on. So today, what I want to do was dive back into that topic and spend more time explaining what happened and how we can think about it or even use it from an investor's perspective, both in the stock market and in the currency market. But before we hop into the tariff story, I want to give you guys a little bit of a background about my personal story, right? Although I spent the last 15 years primarily trading in the Forex market, I actually started off as a stock market investor, and I'm what you call, I guess, a non-traditional type of investor, meaning that I don't have any formal education on finance or economics, no degrees in that stuff. I've got degrees, I've got 2 of them, but none of them in those 2 subjects. And really, I learned what I learned about the market by sitting at the feet of a millionaire investor. Literally, I spent that entire summer, it's like a 3-month period, in his office, just eavesdropping on the conversations that he was having with others and the things that he was doing on a regular basis until I eventually earned his trust and he decided to mentor me. Now, here's the key part. I didn't have a strong background in crunching numbers or digging through financial spreadsheets and stuff like that, but I did have one amazing superpower. Nope, still can't sling webs, but I am really good at putting 2 and 2 together or connecting the dots. So we call that common sense investing. And that reminds me of a funny story. You see, my mentor once told me about something called the Waffle House Index. And for you guys that are unfamiliar, the Waffle House is this American diner that is open 24 hours. Some people love it, some people hate it. It's an ever-going battle. But the thing is, it is famous for staying open no matter what is happening in the world. So if aliens happen to invade and we are in the midst of a big war and I suddenly got hungry, I would feel comfortable going to a Waffle House and getting food because I know that as everything else is burning down, it would probably be open to serve me. Now, all jokes aside, on a serious note, this was actual an informal metric and index used by FEMA where they would kind of gauge the severity of a disaster by if Waffle Houses were open or closed, right? Crazy, but this is some real stuff. So what I would do, and keep in mind, this is around 2007, 2008, like the whole financial Great Recession, I think it was called back then. My mentor would often send me on these little road trips where I would drive around town and I would literally be tasked with counting the number of cars in the parking lots of different stores. And this was his way of gauging both the economy and the individual store, if let's say it was a stock that we were interested in. And although I still think it was just a trick that he used to get me out of the office because I was quite annoying with all the questions I was asking, I think there was some truth in this as far as the common sense investing approach. And it did teach me something that was extremely important, that investing was less about knowing the numbers and more about understanding people. And that's a mindset that carried me through my entire investment journey. And it's a mindset that I use now, even in my active trading in the currency market. All right, so now that we got that story out the way, let's talk about another story. Let's talk about these tariffs. So if you've been anywhere on planet Earth, literally anywhere, you've probably heard about the word tariffs, right? All of 2025, if I can sum it up in one word, whenever I get asked a question, how can you explain 2025 in the investment market, or what drove 2025, or what was the most important thing in 2025? Tariffs, 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 tariffs. I'm sick and tired of hearing about tariffs, but they were that important. And at its most basic level, a tariff is pretty much just a tax, right? It's a tax placed on imported goods and services, and it's used or implemented for Three reasons. I would say one of three reasons, but all three reasons could certainly be the case. One, it's going to make imported goods more expensive. So therefore, in comparison, local products seem to be a better option, or they have a better chance at being competitive. Two, and this is going to be the easy one, generate money, make that money, baby. And three, it can be used as a political weapon or some type of like penalty. So like, if there is some country you don't like and you want to make them mad or penalize them or threaten them, tariffs, right? And in this case, they were used for all three ways. So what's the issue? Well, some of these tariffs were clearly legal, right? Done by the book, but others were implemented using some, let's call it very creative emergency loopholes. And these loopholes are the ones that have been challenged in court. Now, this all ties back to April 2025, where there was this, I think it was April 2nd, I believe, where there was this big thing called Liberation Day. I think we did a podcast on it, but I have no idea which one it is because I've done so many of these things. But if you want more details on that, maybe Google search the Trading Coach podcast, Liberation Day. I don't know. Anyway, I'll tell you about it here. This Liberation Day is when those new creative tariffs were introduced. And since then, the U.S. Supreme Court has been reviewing the situation, and they could issue a ruling next Wednesday, whatever January 14th is. Now, I say could because they never officially come out and say, we're going to make a ruling on this day. The market thought there was going to be a ruling last week, and there wasn't. But that's what the street is saying right now. They're thinking the 14th could be the next day where we could potentially finally hear a ruling on this situation. So why do the markets care? Why should you and me as investors care? Simple, right? The markets have clearly shown that they care about tariffs, right? Ever since this whole thing started, we've seen movement based on any type of news or rumor or actually implementation of tariffs. Therefore, if new news came out on tariffs, I would expect the same, a reaction. Now, from a stock investor's perspective, here's how I view things. You see, many of these US companies have been negatively impacted by these tariffs, right? Because a lot of them get their goods or their raw materials from overseas. They are imported, right? And if these tariffs are reduced or if these tariffs are reversed, well, that does a few things for them. One, cost will come down for them. Two, their profit margins improve. And in some cases, these companies might even be eligible for some type of refund on those imported duties. And who doesn't love a good refund? Yes, free money, even though it's not free money because we paid for it before, but we see it as free money, right? I never understood that about people that get excited about their tax refunds. My dad always taught me this. He's like, you shouldn't get excited about your tax refund because that just means you gave the government a free loan throughout the entire year. And I'm like, you know what? An interest-free loan by the government, and now they're giving it back to me, and I feel happy about it, even though I did them a favor, makes perfect sense. Anyway, back to the investment thing. Here's how it helps us as investors. I'm not going to go through all of them for you. You got to do some homework by yourself. But as an investor, if I can identify certain companies, so certain publicly traded companies, stocks, that I think have been negatively affected by these tariffs, there's a good chance if said tariffs are removed or reduced or given refunds, whatever happens, there's a good chance that we can see a positive effect for those companies as well. So find stocks that have been hit the hardest by tariffs, keep an eye on them, make sure they're good value, right? Meaning that you're not just interested in them because of the tariff thing, but you're interested in them in a general aspect as well. And this is maybe the thing that puts it over the edge that makes it a value buy. And then keep an eye on them as these news events come out. As far as the bigger macro picture, so zooming out on things, one of the most important ripple effects, I guess, that tariffs show up in is going to be the jobs market. And yes, I absolutely think that the two are connected. And here's why. This is the whole common sense investing thing. The more that companies have to pay for in goods, the more their expenses rise. When expenses rise, because these companies aren't in the business to lose money or break even, something's got to balance things out. And usually these balancing responses happen in one of two ways. One, costs are shifted over to us as the consumer, meaning that if a company has to pay more for something, they have to raise prices on that something. And guess who has to pay those higher prices? Us. That's something we're certainly going through right now. And if you want proof of that, go to the supermarket and try to buy more than 5 things without spending $100. And I say it is impossible. And it's all so sad. I've got 2 kids that play lots of sports and they are very hungry and they eat a lot. And it's costing us a lot of money. Anyway, that's one way. Another way is by cutting expenses elsewhere. And unfortunately, one of the easiest ways to cut expenses is by cutting people or firing people or not hiring people, right? Salaries cost a lot of money for these companies. So if they want to save money, salaries is usually one of the first places that they go to. Now, for you guys watching the video version, you should be seeing a chart. I don't know which one I'm going to show yet. It's either going to be the actual graph or one that has like the raw numbers from November 2021 to December 2025. Now, remember those Liberation Day taxes, right? They came in April of 2025. So let's find April of 2025 and let's take a look at what happened after that. As you can clearly see, the April release was 158,000 jobs, which is in that normal range. Remember the non-farm payroll video? I told you the normal range is 150 to 200. That's kind of the place that we want to see our jobs at. And after that, they dropped to roughly 19,000, right? Yes, no, I'm not leaving a zero off. It's not 190,000, 19,000. And they've been pretty weak ever since. Now, obviously, tariffs weren't the only factor. There's lots of stuff happening in the world, and very rarely is something caused by one thing, but they certainly played a role. So to bring this home, right, rounding third base for you baseball fans out there, if these tariffs were reversed, and right now Wall Street is saying they're thinking there's about a 75% chance that the Supreme Court won't rule with Trump. Now, again, this doesn't necessarily mean they will be reversed because I'm hearing that there are different tactics or methods that Trump can take to keep the tariffs in place. I haven't done research on that, so I gotta go back to that after I'm recording this video. But from a general perspective, if these tariffs are reversed, what that could mean is more business. What that could mean is a healthier job market. And what that could mean is economic stability. And remember, jobs and inflation are one of the 2 things that the FOMC looks at when making their decision on monetary policy. So the health of our economy, the health of our jobs is directly related to interest rate cuts or interest rate hikes or interest rate evenness. And if we want to put it together in basic math, because me have simple brain, so strong jobs usually means a strong economy. A strong economy means less need to lower interest rates, meaning keeping interest rates steady or even hiking interest rates. Hiking interest rates equals strength for the US dollar. You've just got your directional bias. Boom! Common sense investing, baby. So I hope you enjoyed the podcast. Glad you guys brought this question to the table because I love talking about this stuff. If you ever have any questions, leave them in the comment section below. And if you're ever interested in learning how to trade with us, check us out, www.tier1trading.com. I recommend starting with the 14-day risk-free trial membership. Gives you access to courses, gives you access to our live resources, and gives you access to our great community of traders with no risk, meaning after 14 days, you're just kicked out. There's no sneaky auto bill that you have to pay. All right, I'll see you guys on the platform. And until next time, plan your trade, trade your plan. Take care.